Imagine you have $10,000 to invest in the stock market. The question is, do you pick a day and invest all of your money in the stock market on that one day and hope you're not at the top of the market? Or do you break up that investment into multiple segments and invest on multiple days so that you can spread the risk that you're not at the top of the market and maybe even hit the bottom of the market? So the second concept is called dollar cost averaging, and it's fairly popular, but from what I can tell, it's kind of bullshit. So here's why I say that. Below, down here, I have a list of the open and close prices of the S&P 500 from 1950 all the way to 2013. And what I've done is I've set up a couple formulas. So what we say is, on average, someone's going to invest for a 20-year period. So this is all based on a buy and hold strategy. So starting with $10,000, if every month we invest 10%, so of $1,000, how does that compare to just pushing all of our money in on one day a year? At the very beginning of our 20 years. So what I did is I wrote a little program that goes through each one of these days and does a bunch of really nerdy calculations. But the idea is, if you just buy and hold, if you bought, starting on 1950, you bought $10,000 worth of S&P 500, in 20 years it would be worth $55,000 and change. If, however, you invest, instead on that first day you invest $1,000, and then the next month you invest another $1,000, and then another $1,000, that will last you 10 months. You'll spread out your investment over 10 months, and at the end of your 20 years, your investment will be $51,000. So that's just for 1950, of course. But what happens if we do it starting on 1951 and 52, so we can measure multiple 20-year periods? And then what happens, let's say we don't want 10% of our investment, we want to spread it out more over time, so 5% and 2.5%. So I ran scenarios for all the years from 1950 to 1993, and then across all these multiple monthly investment percentages. And you can see some years it's a really bad idea to do this. This is the percentage difference between the buy and hold strategy. So in 1954, the market must have been doing really, really well that year, and so it was a really bad idea to spread out your investment over time. But in other cases, like 1973, this was a really good idea. You could make over 30% more by spreading out your investment over time. But at the end of the day, all said and done, on average, you're going to lose 2.5% to 10% by doing this strategy, this dollar cost averaging. And if you want the median as opposed to the average, you're going to lose between 3% and upwards of 12% if you do this. So, it just doesn't seem to make sense. So now let's talk about maybe why it's not going to make sense. So why is it the dollar cost averaging doesn't work? It seems like so intuitive that I want to spread out my risk. Well, in some cases it will work. If this is the day that you happen to invest, you're much better spreading out your risk. But for dollar cost averaging to be an advantage to you, the price has to be going down while you invest. If, on the other hand, it's going up while you're investing, then you should have just been investing at the very beginning, putting all your money in. Otherwise, you're having to pay more and more and more every time you invest. So the question of dollar cost averaging, does it work in the long run? Well, it would work really well if, on average, the stock market was going down more often than it was going up. But the problem is, as you can see from this graph, it more often goes up than it goes down. So if you fundamentally believe that the stock market will go up over the next 20 years, then it just makes sense to invest all of your money at once. Otherwise, all you're doing is basically saying, I think the stock market is going to go down over the next year or 2 years as I invest my big pile of money, at which point you're just timing the market, which of course is what we're trying to avoid as novice investors. So another example, in case this one doesn't hit home. So let's just take a look at some theoretical examples. Let's say you've got $100 to invest, and I could give you a 100% chance that the stock will go up tomorrow. And let's say it goes up by 5%. If you invest, which of course you should, because I'm giving you a 100% guarantee, your value tomorrow of that stock will be $105. If on the other hand you invest $100 and I gave you a 50-50 chance it would go up, so 50% chance it will go up and 50% chance it would go down by that same 5%, you'd be even. You'd be at your $100. It's flip a coin, you know, it could be either way, but percentage and probability speaking, you're at $100. If on the other hand I gave you $100 to invest and I told you there's a 60% chance it would go up and a 40% chance it would go down, that 5%, the value tomorrow would be, probabilistically speaking, $101, because it's just more likely to go up than it is to go down. That's the same concept here with this dollar cost averaging. Any particular day you invest, it's more likely to be more expensive tomorrow than it is today. So you want to put your money in as quickly as possible. Now again, it's not going to work in every scenario, but over the averages, and as we've seen through the simulations, you're more likely to make money this way than you will, or you're more likely to make more money this way than you will if you spread out your investment over time. Okay, so what I showed you before was this is your typical dollar cost averaging. Now, but what happens if we were kind of sexy and a little smarter? Instead of just like blindly investing 10% of our initial investment every month, what if we, let's say, we held on to that cash until there was a drop in the price, maybe like by 5%, and then we invested. So that's what I'm calling bracketing dollar cost averaging. So imagine I have $10,000, but I'm going to invest not all of it at once. I'm going to invest maybe, let's say, this initial percent of 80%, and then I'm going to bracket, and by that I mean that if the price drops down by 3%, then I'm going to invest any cash reserves I have, and I'm going to and this is at 15% of my ratio. Anyway, so just imagine I'm saving up some cash in my reserve pile, whatever's not in here, so 20%. And then as the price moves down, I'm going to pump some money in, and if it goes up, maybe I'll sell some to get some money out. Anyway, this is just a sort of complicated way to sort of lose money, basically, at the end of the day. At the end of the day, it has the exact same problem. No matter what. In fact, there are no years where this sort of bracketing and save my money until the price drops and then I put more money in, where that makes me more money. Because at the end of the day, the stock market is more likely to go up than it is to go down. And then I did one more analysis, and this one is if I have recurring money coming in. This is more common for most of us. So you've got some money that you're going to invest initially, and then maybe you've got $1,000 a month that you're going to invest. Should you wait until there's a price drop to invest that monthly income, so you sort of pool it up again, and then wait until there's maybe like a 5% decrease in the price from some certain price, and then you pump that money in? Or should you put that $1,000 into the market as soon as you get it? And the answer here again is you put it in as soon as you can get it, because pooling your money and waiting, because again, every day you wait, on average, the stock market is going to go up, so it's going to cost you more money to invest. You should just put the money in as quickly as possible. Okay, so some caveats. First of all, I don't know what I'm doing. I'm a total novice investor. This spreadsheets and these simulations could all have huge bugs in them. So if you see something that doesn't make any sense, please let me know. Also, this is making assumptions like you begin investing on January 1st or the closest investing day to that time. Obviously we're not all doing that, so maybe there's something special about January 1st. This is also has everything to do with S&P 500, which is naturally a fairly diversified investment set. So this will not hold up for any other data set. I don't know what the numbers will do, but if you are like me and sort of betting on sort of large indexes, DCA is not the way to go. Okay, bye.